an enterprise AI operating layer for knowledge work and software development. Ted joins us now for more. Ted, good morning. It's good to see you in person. Thanks for being here. Is there enough space for everyone?
There is in this cycle. This is not even close to the 2000 cycle. The only comparison is animal spirits, but this is a major infrastructure rollout. Nothing that we've seen in my lifetime.
Unpack some of that for us. How much runway do you think there is here, and why?
Geez, I think you're talking anywhere from 5 to 10 years. The infrastructure comes first, software comes second, and Anthropic is one of the most disruptive companies. You don't see companies going from 5 billion or 9 billion to 47 billion in revenues in less than a year. I mean, that's eye-popping.
That said, do we have a sense of exactly what worlds this is building? In other words, if this is that disruptive and all of these dollars are going to projects that are worth it, how transformative is this going to be in a way that people really are not wrapping their heads around?
The AI stacks are totally different from what traditional SaaS or software was. I mean, this is a forklift upgrade, not only on infrastructure, but software. And they're not tied together. I mean, infrastructure is first, software is second, but what Anthropic has done is they've not only created this market for coding, which now for a software company, your cost of goods sold goes basically to zero. That's number one. So there's huge operating margin leverage. Second of all, just this knowledge work. If you haven't used Claude, you should, because it will change the way you go about your business almost every single day. It makes you so much more productive. So it's very disruptive. The difference between OpenAI and Anthropic is, if you look at OpenAI, they chose to go consumer, and Anthropic is all enterprise, and that's where the money is.
Does it matter who goes first?
I think it's important to get through the window, because you never know when the window is going to be shut on your hands, on your fingers. You just...
Get Alphabet, just go first.
Yeah, they went first, and that surprised a bunch of my clients. I mean, but that's what's important. The $80 billion basically extends this cycle through 27, just on CapEx. If you're a cloud titan, you know, what Google's saying is, hey, we need augmentation from our free cash flow. So 80 billion is a big number. And then you combine all these other offerings that are coming, the infrastructure build's gonna go through 27 pretty aggressively.
When it comes to Anthropic, you say they focus on enterprise, while OpenAI was focusing more on consumer. How can you be an offering for enterprise if you are labeled a security threat by the DoD? No, seriously, is this not at some point going to hurt them?
It could. The narrative will be sculpted in the next few months, but Mythos is a big deal. I mean, when Jerome Powell and Secretary Bessent call an emergency meeting on a Friday and get Glasswing, what's called Glasswing, the vendors together, I mean, talk about an eye-opening experience, and that's why Palo Alto and CrowdStrike are straight up. There are other small cap companies like Tenable that fit into that Glasswing security issue. This is opening up a whole different total addressable market.
Do you think then the government's going to have to find other inputs that are Anthropic because of the supply chain risk that the DoD labeled it? Or do you think at some point the DoD is going to have to lift their hands and say, we have no choice, we're going to have to work with them?
I think it's B.
Wow. Okay, so the DoD, so basically Pete Hegseth and Emil Michael say you won.
I think there's going to be a cooling off period, and this is a national defense issue. You cannot have them sitting on the outside.
Ted, can I ask you where you think the money's going to be made? I don't know what the sequencing looks like here.
Yeah,
clearly the chip players right now are making all the money, but when you describe the sequencing over the next 10 years or so, infrastructure, then software, where do you think the money will be made?
I think it's going to be in some specific software companies that are consumption-based. I mean, you've already seen it through Datadog, you've seen it through Snowflake. I mean, these stocks are straight up because of consumption adoption of what I call the new versus the old. So from a software perspective, I think what the street misses is these free cash flow, software names, free cash flow, much better than some of the infrastructure names. So over the long term, the software names that get that foothold are going to be absolutely money machines. So it's going to take a while for that infrastructure to pivot, but we're going to see some new software companies just like we saw new software companies in the 2000 cycle.
Who's losing here? Who's not keeping up and likely to fail?
I think it's the smaller cap companies that are features. They don't have the free cash flow, they don't have the engineers, they don't have the scale. The other area would be and it's well known, the SaaS companies have to pivot. I mean, when you have revenues that are 90% SaaS and 10% consumption, that pivot is ugly. And for my institutional clients on the software side, the reason why the IGV was down 30% at one point was just because nobody could work through their models on that transition between SaaS and consumption, and they couldn't get to a free cash flow number. So if you can't get to a free cash flow number, how do you put a multiple on a stock? Now, it's getting much clearer. I think some of the checks coming out of Salesforce on Agentforce are getting a lot better. Even Workday, which nobody's really focused on, it's kind of a value name. I'm on 70 plus conference calls during an earnings season. It's like the Baton Death March. Workday actually talked up their agent momentum. Nobody's paying attention. You got to listen to these calls. So they'll get there over time. And as they pivot, the free cash flow expands.
Ted, just final line of questioning from us. We're laser focused on potential capital constraints. No sign of pushback in the debt market, not for the likes of Alphabet. They've just gone on a $60 billion 4-month debt binge. No sign of pushback in the equity market, not for Alphabet again this morning. They're looking to raise $80 billion in equity capital and the stock's only down by 2%. You seeing any signs of that emerging? Any pushback, any capital constraints anywhere?
Yes.
Where do you see it?
I see it on the debt side. Why do you think all these companies got to go public? They can't raise it in the debt markets, whether it be private or in the normal debt markets. The numbers are too big. That's why on a capital side, they've got to go public. And where my big concern is, and again, is listening to a lot of companies, is inflation is straight up in the tech area. You listened to HP last night. They're not only facing shortages, but they're passing on tremendous price increases. And the enterprise companies, call it the Global 2000, their IT budgets are up 3 to 4%. Do you think they can absorb, a 10 to 20% price increase on a server? The answer is no. So I think there's going to be an issue with inflation, and I'd watch the 10-year very closely.
So final question then on that, on inflation, and we can talk about the bond market.
Yeah.
But just final question on the pushback that we might see. Do you see that ending in softer demand, or do you see that ending with cuts to operational expenses elsewhere? How does a company respond to those high prices?
They go to refurbished markets. I don't think the street is focused on the enterprise at all. They're hurting on price increases. I mean, they have to upgrade all their infrastructure over the next 5 years, networking to storage. I mean, they're somewhat IT constrained. What's fueling this market is the cloud titans. And it's going to go for a while just because of that Google news last night. I mean, you just put gas on a fire. So
just to wrap it up, because a lot of people want to know, you said watch the 10-year. What are you expecting to happen?
I think personally, this is just my personal opinion.
Please go for it.
It's not the firm's opinion. I think that we're going to lose control of the long end. And if the 10-year goes through 5%, I think there's going to be a lot of portfolio managers that look at multiples and try to figure out. I mean, war is very inflationary, by the way. And now we've got one of the biggest cycles in history where we've got over, call it 735 billion of spend, and the supply chain can't absorb this. So the only thing, if you look at the memory shortages, they've got to pass it on. And, I think the inflation inputs in tech are only up, they're not down. So that's going to flow into some of the data, and I think it's really going to surprise some people.
I could speak to you for hours. Ted, it's good to see you.
Okay.
Thank you, sir. Thank you very much. Ted Mortensen there of Baird with a interesting note at the end there on the bond market.
Ultimately, if you have existential spending, and you have this much existential spending, you have it in wartime, you have it in technological build-outs, you have to imagine that's going to come in some sort of ramification when it comes to inflation.
10s this morning, 4:43. Let's get you an update on stories outside.